We're going to go through some of the next section of this chapter, which is depreciation. So we're looking at two different types, straight line and declining balance methods of depreciation. I'm going to go through the note quickly, and then I'm going to go through an example from an old quiz. So, okay, here we go. All right, so basically, remember the cost principle says that anytime you have purchased something, you have an asset, whatever it is, that the value of that asset is recorded at the purchase price for the entirety of its lifetime with the company or on the books. Okay, so you might think, well, that's weird. How does that work when you have, a truck or something? It's not always going to be a $40,000 truck. Eventually, it's going to be next to worthless truck. Well, depreciation is how they handle it. Okay, so it's always going to be on the books as a $40,000 truck, but as we go along, they use what's called a depreciation account, which is a contra asset, and contra not being, the contra asset being the counter. Yes, being the what do we call it? Contra asset. I keep thinking all I can think of is up, down, left, right, BA start, but that's not the contra we're talking about. We are talking about contra being the counterbalance or the opposite of what it's called. So an asset account, right, is a debit balance account. It is a thing you can sell off. A contra asset is as a counterweight to an asset account. So basically, if you have, in this case, you have like a truck, and then you have the contra asset account of truck depreciation. The difference of those two is the actual value, or the not the actual value but more the estimated value of current value of that asset. Hopefully that made sense, but anyway. Depreciation, the other side of it, is there's an expense account, and that makes sense because every time something depreciates, it basically is counted as an expense because you're using it to gain revenue. So that's the way that works. So you have accumulated depreciation as a contra asset, and on the that being on the balance sheet, and on the income statement, it's an expense account called depreciation. Okay, moving on. So example here, $12,000 equipment purchased on January 1st, lifetime of 5 years. So that means they know it's a 5-year asset. After 5 years, they're either going to get rid of it, they're going to sell it, or it doesn't work after 5 years, or it expires, or licensing, or whatever it is. It's no good to them after 5 years. So in that case, every year is going to depreciate at the same rate. They're just going to take it as a straight 5-year depreciation. So they take the total value of the asset, 12,000 divided by 5, and they come up with every year that asset depreciates or declines in value by $2,400 per year. Okay, so that's what this looks like on a monthly basis if you're going to record the depreciation of that particular piece of equipment. So you'd have your depreciation expense, because expenses, right, they're a debit balance account. So an expense account called depreciation expense equipment. It's important to have that designation of equipment. And then the accumulated depreciation is your balance sheet account, right? So that's the contra asset account. It is credited $2,400. Okay, so that is your journal entry. So you've got your expense account, which is the debit balance, or the debit side transaction, and the accumulated depreciation, which is the contra asset, which is a credit transaction. Okay, in terms of our T-charts, it looks like that. And here's what it looks like on a piece of a balance sheet. So you get your fixed asset was that $12,000 piece of equipment. It is depreciated for 1 year, right, by the $2,400. And so the actual estimated value of that equipment for the purposes of the business is $9,600, right? So just the difference between those two. Okay, there are two ways. The first way we just did, that's called the straight line method. That's when you know that an asset has a specific lifetime, or that you have assigned it a specific lifetime, and it's not going to go over that, you can do the straight line method, which means that every year, every month, or every week, or however you want to do it, it's going to decline the same amount every time. So it's just one calculation. If it's per year in this case, divided by 5. If it was by month, you divide it by 5, then you divide it by 12 to find the monthly depreciation rate. But it's a straight calculation that way. The other one is the declining balance method of depreciation. And declining balance is one where you're estimating the amount of depreciation because you don't really know how long that particular piece of equipment or whatever it is going to last. So let's say that you're saying, your fleet, your truck again, you think it's going to last about 5 years, but you're not really sure. So instead of saying 5 years, you estimate that it depreciates by about 20% per year. But it's not a straight line because at the end, the value of that asset is not 0, right? So you see that last number is not 0. So you start with the total, which is 12,000. And this is a yearly basis. We can see if this was monthly, we'd break it down further. But on a yearly basis, 20% per year, which comes out to the first year, 2,400. So that's the same thing. And then your declining balance at the end of the year is 9,600. So that's 12,000 minus the 20% of 12,000 equals 9,600. The next year, you then use the declined balance. So the 9,600 becomes the undepreciated cost starting the next year. So the next year, 9,600, 20% of that is $1,920. You then take the difference of that and you come up with $7,680. That is the new value of that particular piece of equipment after it's depreciated. Then you take again to the next year, you do it again, 7,680. 20% of that is 1,536. Your difference is 6,144. You bring that to the next year because that's the new total, 20%. You get a new total. To the fifth year, you end up with $4,915.20. 20% of that is $983.04. And then you have a final balance at the end of the year of the fifth year of $3,932.16. That's an estimated value of the asset after 5 years. Notice it's not 0 because it's still usable. They could have it year and year and year after, and they just keep declining it further by 20% every year. Again, it's when you're not sure how long the asset is going to last, but it's not a fixed amount like that fixed schedule of 5 years and then it's worthless. Okay, so those are the two differences. We're going to do the math in a second. All right, let's get into the actual calculation here. So we're using these two. First one is a $30,000 piece of equipment and it has a useful life of 5 years. Okay, so that means basically that whatever this piece of equipment is, it is only going to be used for 5 years, and then for whatever reason it's no longer has any value to the business and therefore won't be used. So the beginning value, right, is what we start with. Whoa, hold on a second. Let's get rid of that. No! What's going on here? There we go. Beginning value is 30,000. Okay. Now, for this, you basically take your 30,000 and you divide it by 5, right? I don't know why I wrote it that way. 30,000 over 5, okay, and you're going to get that being 6,000. That means every year it depreciates by 6,000. That's the beauty of the straight line one. You just do that one calculation, you've got it for the whole thing. So depreciation for the year is 6,000. Accumulated depreciation so far is 6,000. And the bookend value is 24,000 because we take 30,000, you minus 6,000, you get 24,000. Okay, so this number and that number should equal this number. Wait, no, sorry. What I meant was these two numbers, if you add those two numbers, they will equal that number. Okay, if you add these two numbers together, you should always get the beginning number. You should always get that number. That's a huge mess now. But basically, that's the relationship I was trying. So let's go back to, I made a huge mess of that. Okay, so now you take this total, 24,000. That's your new total at the beginning of year 2, right? It's still 6,000 because it's a straight line method. We've now accumulated $12,000 worth of depreciation because we take 6 plus 6, get 12. And the book value is now 6,000. So 24 minus 6 gives us 18. We carry the 18,000 over. Again, straight line, so we know that's 6 again. We add another 6 to that, we get 18. Okay, 18 minus 6 gives us 12,000. 12,000 minus 6, straight line. Okay, cumulative depreciation now 24,000. And this gives 6,000 because we've got 12 minus 6. You start with 6,000 minus 6 because it's straight line. That gives you an accumulated depreciation of 30 grand, which gives you 0 at the end. If you have a straight line method, your last number should be a 0. Okay, and all the way along here, this is what I was saying before. If you add this, you should always get the total that you started with. So in that case, this should always total that 30,000 there. These should always be the same if it's straight line, and this would go up by those increments there. Okay. Yeah. Okay. So that one, straight line, that's when you know how long the life of the product or whatever it is. In the second one, we don't know exactly how long it's going to last, but they're going to estimate. So it's always an estimate. It's not like this is an exact calculation. Okay. This is an estimate for accounting purposes. So it's a $120,000 piece of equipment, and they're going to say that it declines at a rate of 10% every year. So every beginning value you're going to multiply. Right? You're going to multiply by 0.10, which is 10. Oh my goodness! It's like I'm writing on the board here, right there, right? Or 10%. Right? That's 10%. Same deal. Okay, so this multiplied by 10% is 12,000. Accumulated depreciation so far is 12,000 because we haven't done it yet at all. We take 120, we minus that 12,000, we get $108,000, and then we start with 108,000. That is critical. You start with the right number, and now you take that 10% off of the next balance. So in year 2, this is the starting balance. You take 10% of the depreciation off of that. Not off the first year, but off the second year total. Okay, so now you're going to end up with $10,800. Your accumulated depreciation is going to be those two numbers combined, so $22,800. And at the end of that, your book value is this amount minus this, or the depreciation for the year subtracted from the beginning total of that year. So that's 97,200. Okay, and then again, 97,200 gets moved to the next year. To start with, that does not look like 97,200, but I am writing at a weird angle here. I just erased that 0. So 97,200. Okay. Depreciation for the year, again, we do 10%, 97,20, right? That's 10% of 97,200. Cumulative depreciation, we add another 97,20 to that. We get 32,520. And then at the book value, is $97,200 minus the $9,720 gives us $87,480. Okay, carry that over, 87,480. Okay, and then we've got 10% of that. So you've got 87,48. You add that to this total, and you get 41,268. And the final total being, or depreciation total being 78,732. If you then add these two numbers together, you should again always, this whole column, when you add them together, you should get the original amount. When you take the end of year book value and you add it to the accumulated depreciation over time, you should always get the original value. Okay, so the main thing here is to make sure that you're carrying the right total over and that you're using that year's total to take off the percentage for the year. Okay, I'm just going to do a little more of a simple example. Those are bigger numbers to kind of drive home my point here. So let's say it's $100 value. Let's say 1,000, and it's still 10%. So 10% of 1,000 is $100. Okay. You know what? I'll go with my original just to keep the number really low. Keep it really. Okay. So $100, $10 is 10% of 100. Accumulation total is 10. $90 because that's 100 minus 10. $90. Next year we get $90. 10% of $90 is $9. Accumulated depreciation so far is $19 because we just add those two together, and then another $9 from the 90. It's $81. $81 the next year. Now depreciation is $8.10, right? That's 10%, 8.1. So that accumulated depreciation becomes $27.10. Okay, and then $8.10, that's $72.90. And finally, $72.90. 72.90. 10% of $72.90 is $7.29. And you add that, you get, what do you get? 34.39. Okay, and then you take that off of off of your total here, your 72.90. So what's that? That's 40. Wait, 51, not 41. 51. 51 and 34 from 72, so that's 38, right? 38.51. That seems, that right? Did I go too far? That doesn't equal 100. That's my bad. Not 38. It'd be, what, 68? 60. Why don't I just do the math here? What did I see? I got myself confused when I do my own thing. So 72.90, 729, right? So that's 1. That is 6. And then that was a 72, so that's a 67. So 67, 61. Does that make that better? I think it does. Right? Because that would be $1, and then, yeah, okay. There we go. My mistake. 67, 61. Only mackerel. That looks terrible up there. 72.90. 67, 61. Now, the last point there, this is not going to be 0, right? So if it is the declining balance method, that's not going to be a 0 because it's an estimate. It's not a fixed amount that leads to a 0. It's going to be some number left over, right, until they sell it, and then that's a different process. Okay? All right. Hopefully that's clear. Sorry about the last little bit of math there. Alrighty.